In this video, we're going to break down an important H4 timeframe analysis of XAU USD. That's gold against the US dollar. You're about to learn what a support break looks like, how it signals a possible trend reversal, and why this single chart can teach you one of the most powerful lessons in technical analysis. So let's get started. This chart you're seeing is the 4-hour or H4 time frame of XAU USD. Each candlestick represents 4 hours of price movement. The green candles indicate bullish or upward movement, while the red candles represent bearish or downward movement. The H4 time frame is often used by swing traders and short-term investors to understand medium-term market direction, typically over a few days. If you look closely, you can see two purple zones highlighted on the chart. These zones represent key support and resistance levels. The upper purple zone, around the 4,160 level, was acting as a major support area. Price bounced off this level several times, which means buyers were stepping in to push the market upward every time price reached this point. The lower purple zone, closer to 3,040, is the next major support area where buyers could potentially appear again. Here's the most important part: the area, marked by the black arrow labeled Support Break-In, XAU USD. This is where the price finally broke below that key purple support zone. When you see a strong red candle closing below support, it's a clear signal that sellers have taken control and that the previous buying strength has faded. In simple words, the market sentiment has shifted from bullish to bearish. Before this support break happened, the market structure was in an uptrend. You can see a clear pattern of higher highs and higher lows. That's what defines an uptrend. But after the support broke, the structure flipped. Price started making lower highs and lower lows, which is the classic sign of a downtrend. This change in structure is what traders call a market structure shift, and it's one of the most reliable early signs that a trend reversal is underway. After the break, notice how the price moved back up toward the broken zone. This is what we call a retest. The market often comes back to test whether the old support level will now act as new resistance. If price fails to break above this area and starts dropping again, it confirms that the previous support has successfully turned into resistance. This confirmation helps traders validate their sell setups with more confidence. For beginners, this chart perfectly demonstrates how markets behave around key levels. A support zone is a price area where buyers are strong enough to stop the fall. But when that zone breaks, it means sellers have gained the upper hand. From that point onward, traders shift their mindset. Instead of looking for buying opportunities, they start watching for sell entries. It's all about adapting to what the chart is telling you, not what you want it to do. So what does this mean for trading XAU USD? As long as the price stays below the broken support zone, the market bias remains bearish. Traders can look for short positions below this area, ideally after a retest confirmation. Stop loss can be placed just above the retest zone, while the next target could be the lower support level around 3,940, where the next potential bounce could occur. To summarize, this H4 chart shows the entire story of a support break, from formation to breakdown, and finally to retest. The key takeaway is simple. When a strong support breaks and fails to recover, it signals a possible trend reversal. Remember, in technical analysis, support and resistance are not just lines. They are zones of real buying and selling pressure. Understanding how price reacts around these areas gives you a powerful edge as a trader. So that's the detailed breakdown of this H4 timeframe analysis on XAU USD. If you found this helpful and want to learn more about price action and smart money concepts in simple terms, make sure to subscribe to Financial Freedom FX, hit the like button, and share this video with your trading friends. Stay disciplined, stay patient, and I'll see you in the next lesson. This H1 chart is the immediate continuation of the H4 story. It zooms into the price action after the H4 support broke and shows how sellers dominated in the lower time frame. On the H1, you can clearly see the same purple zone acting as the pivot. Price approached it, failed to hold, and a series of strong red candles pushed price downwards. In simple terms, the H4 support break that we discussed is now playing out on the H1 as a clear bearish continuation, the higher time frame. Weakness is being confirmed by lower time frame momentum. If you follow the candles from left to right, The first important observation is the momentum candle that closed below the purple zone. On the H1, this looks like a quicker, sharper drop compared with the H4, because one H4 candle is made of several H1 candles. The H1 shows the breakdown happening candle by candle. That strong push lower tells you sellers were aggressive and likely entered with market orders, which produced a flux of selling pressure and wide-bodied red candles. For a beginner, this is how you see institutional or momentum selling on the smaller time frame. Quick, decisive moves with little wick rejection. After the initial breakdown on the H1, price tried to recover and moved back up toward the broken zone. This is the retest on a lower time frame, and it is crucial. On the H1, the retest often shows more precise entry signals. Small rejection wicks near the top of a retest candle, or a small bearish engulfing candle that fails to close above the zone. That failure to reclaim the purple area confirms that buyers could not gather enough strength to flip the level back, and it reinforces the idea that the broken support has now become resistance. Traders who prefer timing their entries on H1 would watch for those retest rejections to enter shorts. Look also at the change in market structure visible on the H1 before the break. There were higher highs and higher lows inside the zone, but after the breakdown, H1 starts to form lower highs and lower lows. This confirms the H4 market structure shift at a more granular level. For risk management, this is important because it tells you where to place stops. For shorts, you place stop loss just above the recent lower high or above the retest candle's high, not arbitrarily far from the zone. That keeps risk defined while aligning your trade with the dominant selling pressure. Another useful detail on the H1 is the speed and size of the pullbacks after the drop. Notice how pullbacks are shallow and quick compared with the decline. That's a sign of a strong downtrend. Shallow retracements indicate sellers are still in control, and buyers are only offering temporary resistance. For entry strategy, you can treat shallow pullbacks as opportunities to enter short with tighter stops, while deeper pullbacks that form clear bullish structure would warrant caution because they may indicate a larger correction. On the H1, you can also mark minor support pockets, small, blue-shaded areas below that acted as short-term halts to selling. These are intraday support zones where price paused or produced wicks. They're helpful for planning partial profit targets or scaling out of positions. Because the H4 lower support around R3940 is a bigger zone, the H1 minor supports are intermediate targets that often get tested before price reaches the major support. Managing trade size and taking partial profits at these levels is a conservative way to protect gains while leaving room if momentum continues. Liquidity dynamics are another point beginners should understand from the H1 continuation. Market makers and smart money often run price into visible liquidity, stop clusters, above broken supports to fill sell orders at better prices, and then push price further down. On this H1 example, you can see moments where price spikes above the zone briefly before falling. Those are liquidity grabs or stop hunts. Once you recognize these patterns, you learn to avoid entering at obvious liquidity pools and instead wait for the retest rejection after the hunt. Putting H1 and H4 together gives you higher confidence trades. The H4 showed the major supply-demand flip, and the H1 provides the timing. The correct approach is to align with the H4 bias, bearish after the break, and then use the H1 to wait for clean retest confirmations and favorable risk-reward setups. If price unexpectedly closes back above the purple zone and forms higher highs on H1, that would invalidate the short bias and tell you to step back. Always let price prove the direction. Finally, practical trade rules from this H1 continuation. Only consider short entries below the confirmed resistance after retest. Place stop loss just above the retest rejection high. Consider scaling out at the intraday minor supports while holding some size to the H4 lower support, and keep position size small enough that a failed retest won't blow your account. This H1 continuation simply illustrates a textbook sequence: break on the higher time frame, confirmation and precise entries on the lower time frame, and clearly defined risk and targets, the core of disciplined technical trading.